up? Clueless? Ask Clunis. We're gonna have a great time. We're gonna talk about the market a little bit. We're gonna talk about why you wanna invest in real estate. We're gonna talk about multiple ways of investing in real estate. Yeah, I'm excited. So my pops right here, my man.
Oh, nice to meet you.
Thank you guys so much for coming. I'm hoping that you get a lot out of this. I want to bring up my first guest. I have Chris De Souza, who is a mortgage broker. He's been doing it for 10 years. He is from Mortgage Architect. Yes, I keep forgetting. I'm like, how do you say their name? Yes, Mortgage Architect. He specializes specifically with investors. He obviously does first-time buyers as well, but his main, I guess, bread and butter is working with investors, because I do have investors that are in this room that have multiple properties that are probably getting to a point where they're like, okay, I don't know what to do now because the banks are no longer loaning me money. Well, this is when you will speak to somebody like Chris. So we can all just give a hand to Chris.
Thank you, guys. Thanks.
So Chris, I'm glad you're here. Again,
you.
we're going to make it very informal. We're just having
No
a conversation,
problem.
and we're going to have everybody ask their questions afterwards.
Tristan, thank you for having me. It's nice to see these seminars going on. I wish when I first started, these seminars were happening to help me get started as well.
Awesome.
So
go ahead, talk about. Let's hear about you, man. Tell me about yourself, man.
Me,
Not like you like long walks on the beach or anything.
No,
like that.
no.
You
I
don't
got
have
to
to get
save
into
that for
we
later.
don't need to get into that. Yeah, later on we can do that with the wine and cheese. But yes.
I fortunately fell into the investment side of things when I first started in brokering, and fortunately the clients that I was getting already had multiple properties. So it was interesting to see how people were growing their portfolio, and as I said, I was growing my portfolio as well in the same time, and there's just no education around it. And the number one problem and an issue right now is people want to invest, but they just don't know how.
Right.
And so what we do is, for myself, is we show you how to build that financial blueprint, which you had mentioned earlier, which is called a REAP. It's a real estate action plan. And what it does is I walk you through the process from start to end, and you know exactly what you can qualify for. You know what type of property you can buy, and we even narrow it down to the city that you can buy in as well. So the plan is really put in place before you even get into the market. Most people jump in without knowing what their affordability is, but we all have the expectation of saying we want 5 properties. But how do we get there is the question. And the map really is designed to say, here's a 3-year plan, a 5-year plan, and a 7-year plan. And how do you leverage your properties to continue to buy more? And based on your income and your credit, it's really dependent on how many properties you can buy at the time. But again, it's, like you said earlier, it's a patience game. So the longer you wait, the longer you appreciate your property appreciates in value, your principal gets paid down, and in between along the way is what we call your profit, which we now show you how to use it to either pay yourself back for the down payment that you came up with originally, or you use it towards purchasing another property. But understanding the logistics around it is the most important piece, because it's education. Where a lot of us, like I said, we want to do it, we just don't know how. So from a first-time home buyer perspective, I'll just tap on that very quickly. There is products that are available where you can borrow up to $500,000. You can put up to 25K. Anything above that is 10% on the difference. You do get your first-time home buyer's plan where you get your land transfer tax, and you get you can put your RSPs towards it as long as it's been sitting in your account for 90 days. But again, like as a first-time home buyer, the more income that you show, or that you can partner up with somebody to combine your income, the less of the down payment you can put down. So it's challenging in today's market because the interest rates are so high. The qualification rate has jumped to 5.45%, plus the banks add another 2% on top of it to ensure that in the event that the rates go to 7.25%, you can qualify and you can continue to pay for the mortgage. From an investor standpoint, it's all about leveraging. How do we use the leverage and the equity in your property?
Before you even get into that, I want to kind of stick on. Sorry, let me interrupt.
Yeah, no problem.
For the first-time home buyers, like walk us through even just what are the steps to like what do you need? What are the things that you need that you require in order to get a home, like income?
Yeah, so you're going to need and this applies to the investor side as well as a general rule where you need your income. You need to be in your position for at least minimum of 3 months. You can't be on probation. You need a down payment. If you're putting less than 20% down, then it goes to the insurer, which is CMHC, Canadian Mortgage Housing Corporation, Canada Guarantee, and Genworth, where they insure the bank that you're able to make the payments on the property. And your amortization is now at 25 years because you're putting less than 20% down.
And what's amortization?
25 years.
So what is amortization?
Oh, the amortization is the length of how long it's going to take for you to pay off the mortgage. Now, what happens now when you qualify at the same rate with the 25-year AM, it decreases your borrowing power by 30%. So the goal is to try and get you to come up with the 20%, which is why I'm saying if you joint venture with someone as a partner or even as a first-time home buyer, the more income that you have, the more borrowing power you have access to.
Would you suggest, so I hope you guys got that, because a lot of, especially it's funny, for a majority of the crowd is just to let everybody know on YouTube, majority of the crowd, and especially my culture and the Black culture and the Caribbean, nobody wants a partner. Everybody wants to do their independent thing.
Yeah.
Nobody wants, I want to do my own thing, and and this is the shoulders, and everybody wants to do their own thing. And I'm pretty sure it's not just in the Black cultures. I'm pretty sure it's in a lot of cultures. But you see a lot of other cultures, they will have about 4 or 5 families in that home.
Yeah.
In that one house. And we clown them, and we say, oh, look how many people are living in that one house. But they will all put their money together, buy that one house. Then they'll put their money together, buy the second house. The family moves in. Put their money together, buy the third house. And they're able to build. Meanwhile, we are so caught up with trying to show face. And this is just the reason why I kind of wanted to touch on that, because it's so important. Get together with somebody else just to get in the market. Yeah. There's some people in this room that have done that and are seeing the benefits of it because they, maybe got together with their sister and they say, you know what, we're going to go ahead and buy property, even though, it's not ideal for us. We want to do our separate ways, but we're going to go and buy property. Now they have a property. Now they have equity that they can go ahead and buy the second one. Yeah. Now the other person can move out. Yeah. Having that mindset is crucial.
Yeah.
Sorry, go ahead.
We can start ask questions the same time as you're talking?
Sure, go ahead.
What are the creative ways of acquiring a property together? As you mentioned that in our culture, we're not easily coming together to build in real estate. So what are some of the creative ways of coming together?
He's asking, what are the creative ways? Obviously, as I mentioned just now, you had, I'm suggesting people get together, get with a family friend, or whatever the case would be, you guys come together, your buying power grows. What are those ways to creative ways to get together, and how does that look, I guess, on paper?
Yeah, for sure. So just to kind of take one step back, there's an exit strategy, whether you're an investor or whether you're a first-time home buyer. And if you are joining forces, then at the end, it's, well, how do you split the equity and how do you go purchase your own home? Because now it's a forced savings. For somebody like you're referring to, if they have less than a 680 Beacon score, then there are other options where A-lending will still give you a mortgage, even if your credit score is 640. If in the event that you have a Beacon score less than 640 and it's in the 500s, yes, you can still get a mortgage, but it's going to be on the alternative side, meaning that there's alternative lenders that specialize in individuals that want to buy property, but they don't have the credit, or they may have gone bankrupt or into consolidation, they may have gotten divorced. But what happens is, at that point, you can still purchase, but you would have to put down 20%. Okay, so the bank now will only offer you a 1, 2, or 3-year term, and again, the interest rate is slightly higher, and they'll charge you a fee to facilitate the transaction.
Is that something that you would recommend, just to get into the market?
Always. Like, you got to work out the numbers. I always say the numbers don't lie. In the event that you're paying 50 basis points or even 1% higher than what A lenders are rates are, you're looking at a $300 to $400 difference in your price in your payment. But when you do the math around it and say, well, if it's $300 a month at 12 months and that's $3,600 for the year, if you're buying, a $800,000 property and you're putting your 20% down, is that property going to appreciate more than that $3,600, which is the $300 times 36 to make it $3,600?
And as I said, on average, for the past 40 years, we've had the average price increase has been around 7% in the GTA. And most years, especially for the last 10, 20 years, is even higher. Right. But we're looking at the 40 years, including that whole slump that I showed you on that graph, it's been around 7%. So that kind of goes to show that, yes, it would be, on average, if you're keeping it long term, that you should be. That's okay. A safe bet.
Yeah. And the banks can't continue to have the rates this high. It's at some point, as rates go down, the values will continue to appreciate and go up. So you'll make your dollar back, but it's a waiting game.
Right. Awesome. Right. I think we have a couple more questions. Yeah,
I heard you say that if somebody's, let's say, in their position for about 3 months, then they can, they'll be able to show, a consistent, amount of income. But let's say you and your spouse are both self-employed, right? But you essentially have the income to show that you can sustain payments, but you've been self-employed only for maybe a year and a half. Sure. And you already have a home in your name, but you now want to invest. What are, banks or the
options for you?
Yeah, what are the options?
Yeah, so that's a good question. A lot of people for business for self, if you do the math around it, most people think that they have to earn, $120,000, $140,000 in order to be able to qualify for that property. But being a business owner or having your own business, you got to look at it and say, well, if I'm earning $120,000 and I have to pay $30,000 in tax, why not go to that alternative lender? Every bank has their own appetite in terms of how they qualify, what documents they look for, which will allow you now to show just your business bank statements. So if your business bank statements are healthy, and let's say for 6 months you average, $60,000 for the year, well, now we can annualize that and say, well, you're on track to earn $120K. But then we can also bump it up based on your income and your expenses of the business to help you qualify for a little bit more. And then, when you do the math, like I said, you're not going to want to pay $30K that you're not going to ever get back. Whereas if you put down, if you pay the extra $300-400 a month, like I mentioned earlier, and you pay that, let's say it's $1 million and you're paying $10,000 to the lender for their fee, that $13,000 is still cheaper than the $30,000 that you're paying. And at some point you can refinance the property, pull the money out, pay yourself back as it appreciates in value.
So my question for you is, how many properties can you refinance at once?
That's part of the real estate action plan, right? So it's when do you refinance those properties? Do you do them all at the same time? And how do you refinance them? Are you taking it out in the form of a line of credit, or are you taking it out in the form of cash? And both options have different qualification rates in order for you to go purchase that next property. So in a lot of cases, it's easier for you to refinance one, purchase the property, get into that next property, and then move on to the second. If it's feasible where you can do both or all three at the same time, then we'll do all of it at the same time. So now you can kind of grow your portfolio and diversify your investments from A to Z.
The REIPs, the real estate action plans, those are things that there's no cost.
Yeah.
Like that's something that we offer as a service, right? So there's no cost to it. Yeah. If you do feel like you want to be able to, go through your finances and look like, okay, in the next 3 to 5 years, these are my goals. I want to be able to buy my first property, or I want to be able to buy my second or my third. That's something that's a conversation that we can have, and there's no cost to you to have that conversation. Mm-hmm. So, sorry, you have more questions? Yeah, one more. Go ahead.
Sure. Yeah. So, if you're having your properties appraised, does the appraiser take in consideration the last couple of homes that have sold, along with pre-construction and what is being currently built, or is it just solely off of what has been sold and closed and finalized?
Good question. Yeah. So it's based on the last 90 days of properties that have sold in the area. And they take, based on your fixtures and finishes and the style of the home and the lot size and so forth, they'll calculate it all. There's plus minuses on the report itself, but it's the number that they come up with is all within the last 90 days of the sales.
Or just piggybacking on the question for refinancing all the properties at the same time, when you're doing that, are you using one solicitor or you're needing to have 4 different solicitors for that?
No, you can use one. Yeah, we're not doing anything wrong. We're just doing it in a way where we're showing you how to do more, right? And like the banks know that we all do it. It's just a matter of who's in the position to do it and what timing or what time frame does it work best for them.
I kind of get a lot of stuff from Tristian in the past, but one thing came to mind was we always think about the refinancing part, and every investment is different when it comes to multiple units. So in her case, it would be kind of a leveraging, or you're shadowing one to get in on the new one, right? So, you have different options. So it's many ways of getting into the piece of the pie there.
Yeah. So, I mean, just to tap on the 3 properties and the refinancing of each, if you already are at 3 or you're getting to 4, at some point the banks will only allow you to go up to a certain number of properties where you're going to be capped out. So the trick behind it is, you may have to start to learn about buying under a corporation and how many properties can you continue to buy and still be able to refinance those properties under that one bucket. When you're buying under a corporation, what happens is I call it goes into airspace, kind of like into iCloud space. So every time you qualify for one property, let's say it's for $800,000, anytime it goes into a corp and it's an individual corp, you can continue to buy for that $800,000 every time. So the capital that you're raising with the refinancing that you're pulling out, we would crunch those numbers to make sure that you're in the position to buy another property for 8, 7, 6, whatever that number looks like.
So just to clarify, so under your own name, you're only limited to X amount of property?
Yeah, like the rule for most A lending is 6. Some of them will do 8. Some will do it with a secondary home and then do 7. But again, it all depends on the appetite of the lender. And there's a lot of banks that we have access to, being a broker, that will not just be your top 5.
So what about if it's co-ownership? So is that 7-7 or is that 7 conjoined?
No, if it's together. And to tap on that, if you have a property, with me, for example, and you want to go buy another property, we qualified together. But when you go to buy your own property, or if I go buy another property, I still have to include the property we purchased together as part of my debt ratio, and you would have to do the same thing, right? So that also decreases your borrowing power. So the strategy around it is, how do you leverage your properties continuously? How do you refinance and maybe pay out the partner, keep one property under your own name, get back all of the equity, and then you guys go do something else with it?
Is it best to keep your properties in your own name or to do the corporation thing? Because then there's taxes and all that liability that comes towards you. And if something happens, they can sue you if you do it under your name versus when you do it as a corporation that's coming after the company.
Right. Yeah, that's right. So it does go after the company. The company is the owner of the property, not you. You're personally liable for it. But in terms of getting the credit around it, the purchase of the property.
Is that the best strategy to do?
It's always nice to have a few under your personal name. And like I said earlier, then we figure out that space and that gap within your portfolio to say, well, how many properties do you continue to buy under a corporation? And how many times can you continue to leverage these properties to continue to reinvest in another property in another corp, right? So you always need property under your corp because you want to be able to refinance them as many times as you can. Alternative lenders don't offer variable rates. So to break the mortgage on a variable rate is 3 months of interest. Whereas if you go under a corporation, it's that much more expensive, and then it's eating into your costs.
Do you have lending institutions like that where you have a pre-existing relationship with that you're recommending, or is it?
Yeah, I will narrow down the institution. I will tell you why. Again, because they all have different appetites. But if you're looking to grow your portfolio and you say, I want 6 properties, then we got to play with the institutions that we go to.
Do you have somebody on the phone, you're going to call them up and say that, I have perspective?
No, I do it all. I do it all myself. So I know where it's going to go. I know what each institution is going to look for in order for you to qualify. We do have, my brokerage does have designated underwriters. We do, what you're getting from someone like myself being around for so long and doing the volumes that we do is the relationships that we have with all the institutions. So it's a little easier for me to work with them because they know the nature of my business. They know I specialize more on the investment side and showing people how to buy multiple properties.
So when you're making a call, they kind of have an idea who you are already.
Oh, they know me 100%. Yeah. We like I said, they're designated underwriters that take care of my files only, and like we don't get put into a queue or anything of the sort like that.
So when you're purchasing a home and you're having to use the qualifying rates, the rates are higher and your purchasing power goes down. When you're refinancing in order to purchase an investment property, are you also being qualified under the higher qualifying rates?
Yeah.
So purchasing another property would be just as challenging, I guess.
It is. It definitely is a great point too as well. It's challenging, but what happens is, like again, I said earlier, every bank has their own appetite, meaning that some institutions will use a rental offset to help you pay, which will contribute towards the rents. Other institutions will only use 50%. Some will use a rental worksheet. Others will say, no, we're capping. We're not going to include heat or your property taxes. So again, it's to the gentleman besides you, to his question, it all depends on where it fits based on the type of property that you're buying, the time that you're buying it in, and then we map it out further to say, well, here's where you are today. We can move this mortgage to another institution in the interim down the line if you're looking to buy pre-construction, which Tristian is always on top of, or if you're looking to buy a resale home. Again, it's a timing piece. When do you buy each one of them and how? Are you leveraging your principal residence to go buy that rental property, or are you leveraging it to go buy pre-construction? My theory behind it is get into purchase a rental property on the resale side, let that appreciate in value, leverage it, and then use the money from it to go purchase that pre-con.
I know in talking with clients, people have this thought process that to go to anywhere else outside of the major banks is like, don't do it. Like, oh no, I don't want to go to any alternative lender or B lender. Guys, just to get the deal done.
Mm-hmm.
You know what I mean? If it has to be with an alternative, there's nothing wrong with it. I mean, obviously you may pay a little bit more, but you're going to get the deal done, especially if you're buying your second or third property. And it gets a little dicey now because the lenders are now being a little more tight. It's not the end of the world to go to a B lender. It's not the end of the world to go to an alternative lender. So just kind of want to...
Yeah, and if you did have to start off with an alternative lender, again, the goal is really to, as the property appreciates in value and the principal is paid down, now we can always move it over onto 100%. The A side, but it's just getting your foot in the door.
Getting the deal done, for sure.
Yeah.
Is it always a good idea to be frank with the lender as to what you're going to be doing?
That's the whole reason why we do what's called an intake call. The intake call is part of the real estate action plan, and it allows me to determine how I can help you. And if you're in the position to buy now, or if you're in the position to buy 6 months from now, if it's not now and if it is 6 months later, then what do you need to do to prepare yourself to get there? And once you have all of those pieces of the puzzle in place, then we can send you back to Tristian to start looking at properties. A lot of times, I mean, we limit the information. You know, TMI, too much information is never good. You know, to put out there. For you guys as an educational standpoint, I'll spill out all the beans, no problem. But at the same time, it's always just we try to eliminate to say how many properties you're looking to buy in the future because we don't know. But that's why you have someone like myself to kind of guide you and educate you to tell you how you can buy those properties. And when the time comes, then we'll let the bank know.
Yeah.
Yeah.
I think it's important, just no matter what level. Again, there's a lot of people that are in different levels here in terms of where they want to be in real estate. If you're looking to buy your first home and, you know, I don't even have my down payment, I know I don't have the credit, having the conversation up front to get on the right plan, even if it's a year out, like I think it's important to even just start that real estate action plan. I find for myself, unless I have a plan, it doesn't get done. So at least if you have a plan, you have conversations with people, it's written down, you have somebody that's going to be there to hold you accountable. Now you're going to actually make those necessary steps to get to where you are. Where if it's buying your first home or if it's buying your fourth home. Like I think it's very necessary for us to have these real estate action plans, and that's the reason why I started doing them, and Chris has been doing it for years as well. So I appreciate you, my man. I want to be respectful for your time. I also want to give Lawrence his time as well. So if you guys have any other questions for Chris, please, at the end of it, you can always reach out to him. We're going to have his contact information. I'm going to probably send it to you guys by text or by email. So you can have both Lawrence and Chris's contact, and we can kind of go from there.
Yeah, I'll be happy to.
Thank you, my man.
Appreciate you.
Thank you.
All the best, man.
Thank you, buddy. Second half is a little bit different. It's still investing in real estate, but we're going to be talking about another way, a unique way to invest in real estate. I did a webinar with this gentleman here, and it was awesome. I got so many comments, so many questions. His name is Lawrence Raponi. He's a senior associate for Equiton Financial. He's going to explain to you guys exactly what Equiton Financial, what they do, how you can invest in it. It's as low as $5,000, guys. So I brought him on because I know it sounds crazy, but it's a very different way of investing in real estate. And again, it's a different option for those that are like, okay, can't qualify, I don't have the massive down payment. This is another way for you to invest in real estate. So without further ado, Lawrence, come on up, my man. It's your time now, man. Thank you so much for coming. Come and sit down. No problem, brother, man. All right. So yeah, please, Lawrence, explain to us what you do over at Equiton and what your company does for people.
Yeah, for sure. So I'll say a quick few words just about myself.
Go ahead.
I've been investing in real estate since I was an adult, pretty much. I bought my first investment property at 23 years old.
Nice.
Now I manage 11 units, and my portfolio consists of both direct real estate ownership, so conventional investment methods like going out and buying that income property, but also private investments like Equiton's. And really that's the topic of today's conversation, to learn a little bit more about what private investments are, how they could fit into your investment portfolios, why they're good for some people, why they're not so good for some people.
Right.
Yeah, we'll flesh that out. So I work for a company called Equiton Capital, and we help our investors build wealth through investments in real estate, where you can invest passively. And passive real estate investment is a way to invest in real estate where you don't need to be the landlord yourself. You're not tasked with managing that property on the day-to-day. You don't have to build a financial model to determine the value of this asset before you purchase it. You're not vetting your tenants for credit quality. You don't have to get the call at 11 p.m. because the dishwasher's leaking and the guy's pissed off. Now the water's going into the next unit below.
Right.
And I always like to say, being a property manager, being a landlord, it's a part-time job on a good day. On a bad day, it's a full-time job. And so these other types of passive investments come in to alleviate a lot of that for investors, right?
Nice.
Because a lot of investors want exposure to this type of asset class, but there's a few obstacles in the way. And you actually touched on something earlier with Chris, right? And it's the sky-high price of real estate today, right? You were saying in the 1980s, the average price of a home in Toronto was around $230K.
Yep.
That is now the down payment for a home in Toronto.
You have to have that 230 in cash.
My antennas went crazy when you said that, because then I'm thinking in my mind, well, in 50 years, is $1 million going to be a down payment on a home? Like, your head explodes, right? And so there are a lot of obstacles to investing in real estate, the least of which is coming up with a huge down payment and then pushing it all in on one property. Right? And so another nice, I guess, advantage of these passive real estate investments is that a single investment, as little as $5,000, gives you instant diversification, right? So you're getting exposure to a whole portfolio of real estate properties, right? So for instance, we have a fund, the residential fund, it has 30 properties in it.
Wow.
Right? So as an investor in the fund, you're sharing in the profitability of all 30.
And what does that look like in terms of, do you have to qualify to get in? And what does that?
Yes.
What does that
So
mean?
we do have certain qualifications, and they're based on either income or net worth.
Okay.
Right? Now, in years past, these types of private investments, they used to be called private equity. And it was reserved for the one percenters, the super high net worth individuals, the top of the top of the top. Now, changes in regulations have really brought those eligibility requirements way, way down so that anyone can participate. And at Equiton, we can accept investments from anyone. And
That's
I said this on our last webcast, but now, about 5 months ago, I did an investment for an undergraduate student. No full-time job. right? But she wanted to take responsibility of her financial future,
Right.
and that started with an investment in Equiton. Everyone can qualify. So anyone can come in as long as you're 18 years old. Even if you have no income, you qualify to be an investor. The amount of your financial eligibility will say your income and your net worth determine how much you can invest, not whether you can invest.
Gotcha.
So, for instance, if that lady was unemployed and all she had to her name was $10,000, I couldn't take every penny of that, right? Because that would mean 100% of her net worth is at Equiton. Not a great proposition. It could be risky.
And you're
Right?
bound by your
My
license to do
name,
that.
my name, I underwrite every investment I do.
Right.
So if something needs to be reviewed, if the CRA comes in or the Ontario Securities Commission and wants to see who approved this investment, my name's on it, and I get to answer those questions.
Right.
So there's a fiduciary duty to represent the best interests of my investors. But maybe we should take a step back, Tristan, and just talk about how these investments work. Because
Please,
I'm jumping in different areas here. So essentially, we run 2 private real estate funds. And a private real estate fund is nothing but a portfolio of real estate assets. Think of it like its own company. And this company goes out and acquires properties.
Right.
So you, as an investor, are purchasing ownership units in this company, right? So now you'll own 1% of this portfolio.
Right.
And you'll share in the profitability of all of the properties contained in that portfolio. And that's exactly how it works. Think of it like a giant joint venture. Instead of 2 people, there are 7,000 people. And instead of $1 million together, we manage, $750 million.
Wow.
So these are big numbers. This is institutional grade real estate.
How long you guys been around?
We started in 2015 with an original investment of $1 million and 3 employees. Now we're at about $750 million in assets, 125 employees, and over 7,000 investors. Now, and we just continue to grow. And we're unique at Equiton because we do all of our own in-house property management, and we do all our in-house developments. So there's many different pieces that make up Equiton, and we have different investment vehicles. So we have our fund-style investments on one side, and very similar to what I mentioned earlier, where a single investment gives you exposure to every property in the fund. And then on the other side of the equation, we have direct investment in land developments. And so think of that as you own the company that is going out and building a property, say a condo, right? And so your profit's actually going to come from when those condo units get sold pre-construction. Right?
Awesome.
And we, again, talked about this on our webcast.
Yeah.
People think when you buy a pre-construction condo, you're saying, oh, like I'm the first one in, I'm getting a really good deal, this thing's going to appreciate in value like crazy. You're not the first person in.
No.
You bought it from us. We're the first persons in. We bought it. Oh, sorry, we built it.
Right.
Right?
The first fund that you were talking about, what kind of interest rate, what kind of interest can one?
The returns. We'll talk about returns,
yeah.
Yes. So I don't like using the word interest rate because we don't pay an interest rate. Of course, there are profits to be made, but we set up this fund in particular, the residential fund, which is a buy and hold residential real estate strategy, similar to you going out and buying a duplex or a sixplex, whatever. We've set it up to mimic actual real estate ownership, right? So let's take a step back and just talk about the value proposition for any buy and hold real estate investment, right? There's only 3, always, and it's always the same. There is capital appreciation.
Yep.
The building you purchase is going to go up in value. Doesn't matter if it's a bungalow, a condo, etc. The second thing is, as you continue to pay down that mortgage that Chris got you, you're going to realize more and more equity that you own in the property, right? You might start with 20% down, but over years, it's going to go to 25 to 30 to 50 until it's all yours. And the last value prop, most obvious one, is cash flow, right? Any buy and hold real estate investment you're going to make, you're going to have a tenant in it. That tenant's going to be paying you monthly rental revenue on a monthly basis. Now, I walk you through that example to illustrate that the funds actually operate the same way, right?
Nice.
As the buildings appreciate in value, we raise the unit price of the fund to reflect the value to our investors. And the whole time that's happening, you're being paid a monthly cash distribution, direct deposited into an account of your choosing on the 15th of every month, just like a tenant's going to be paying you if you own the duplex or if you own that condo. It operates the same way, right? The same benefits are there. Now, in terms of the total return you can expect, we target returns between 8 and 12%. So this fund, I like to say on average, going to give you 10% annual returns.
Nice.
Right?
Awesome.
Which is really nice. Now,
that's the first fund.
Exactly. The nice thing about the residential fund, the returns aren't sky high, right? You're not going to earn 37% annual returns. This isn't a tech stock or cryptocurrency,
Right.
but it's beautiful because in 7 years that it's been in operation, it has never dropped a penny in value.
Wow.
No investment in Equiton has ever dropped in value. That's something that we pride ourselves on. So your capital's protected.
Nice.
Right? And we have a track record that has proven that. Right?
That's awesome. So that's the first fund.
Yes.
The second one from because I know a lot more about Equiton now, which is awesome, is a little more risky.
It's a slightly riskier fund
But
with a
it's
different strategy.
Right.
But it's the better performing of the two. The residential income
question.
fund. And it's a classic buy and hold residential real estate strategy.
So even before you get into the second fund, how long do you have to hold your money in these funds?
Good question. So for investments in these funds, I always tell clients, you're buying a synthetic investment, but you need to treat it as real estate because it operates as real estate. Now, you would never be a short-term holder of real estate, and you should never be a short-term holder of Equiton's investments. So the minimum we're looking for from our clients is 5 years.
So 5
Okay?
years. So be
It's a
prepared.
5-year investment.
Again, nothing that we're talking about today, as I said from the beginning, is going to be quick flips, 1 year, few months. It's all going to be 5 years or more because that's where you win in real estate. That's proven.
Yeah, it's a long game.
Yeah.
Now, we do have what's called a soft holding period. So if you need to redeem your investment, God forbid, family emergency, your kid gets into Harvard, now you need 100 G's for tuition, could be good or bad. You can always honor your redemption. You can always ask for a redemption of your investment. We've always honored it, even if it's you make an investment today and you want to redeem tomorrow. The way we enforce that 5-year minimum is by imposing early redemption fees on the investors that redeem before the 5-year mark. But the idea is to stay in for 5 years. If a client told me, I need my money back in a year and a half because I'm buying a cottage, I'd say, this isn't right for you.
Right.
Go put it in the stock market where it's very liquid.
Right.
So you start earning a return from day one. So our distributions are paid like clockwork on the 15th of every month, just like when the rental check comes in.
So right away.
So you made investment September 21st, October 15th, you're going to get a cash payment. November 15th, you're going to get a cash payment.
And these are from existing properties?
Yep. So we currently have 30 buildings in the portfolio, and they're large-scale apartment buildings. We're not going out there and buying a duplex. We're going out there and buying 15-story towers with 250 units, right? Full-on apartment buildings. And we have over 2,150 units spread out among these 30 properties. And so as an investor in the fund, you are an indirect owner of all of the properties, and you share in all of their profitability. Okay? And it's diversified.
Do you have an average or estimate of how much you invest and how much you're getting in cash per month?
Yes. So like I said earlier, we average 10% returns annually. The official target is between 8 and 12. Of that 8 to 12, 6% is paid out in cash. Right? So a $10,000 investment would give you $50 a month. $100,000 would give you $500 a month. The remaining 2 to 6 out of that 8 to 12, you're going to see in the form of increases to the unit price of the fund. Right? The unit price of the fund will go up just like a stock price would go up to represent the appreciation of the buildings. Right? Same as when you go out and buy your own property, right? You're going to put in a tenant in that property, that tenant's going to pay you rent. But over time, the actual property is going to go from 500K of value to 550 to 600. And so that is what the unit price increases represent. Meanwhile, you're getting paid the monthly cash as well.
So the example you gave where you put in $5,000, if after 10 years I wanted to pull my money out, I would be getting more than $5,000 back. Is that right?
Yes, because the actual principal continues to rise. And for investors that don't need access to the cash, we have a DRIP, a distribution reinvestment plan, whereby instead of receiving the cash, you can roll it back into the fund to repurchase more and more units on a monthly basis, which is a great thing to do if you come from a dual income household, right? You certainly love that your investment's profitable, but maybe you don't need access to that cash.
Right.
So roll it forward, right? Invest in yourself.
Right.
And then this snowball effect starts to take shape, right? And this is a feature that we can turn off and on as your situation dictates, right? So maybe for the first 9 months, you want to reinvest those distributions. And then, I'm retiring, I'm moving to Costa Rica. Lawrence, I want to start receiving my cash flows.
You can make that
right?
change.
But I want to save the nest egg that I'm investing for my children.
Nice.
Right? So we can do that.
Awesome. So I just want to, because there's a couple of things that I want to touch on, but I'm thinking, do you want to get into the second fund first, or you?
I want to cover the second fund lightly, and then there's a little more to cover.
Yes, go ahead.
So the second fund is a slightly riskier fund, but it is the better performing of the two. And this is the fund with the minimum $5,000 down payment. Now, the second fund aims to give investors exposure to different types of real estate asset classes. So it's not just a buy and hold residential play. There's 3 asset classes contained in the balanced fund. That's the name of the fund, the balanced fund. There is income producing commercial properties. So same long-term buy and hold strategy, but not with residential, with commercial. The second is private lending. So there's an element of this fund that's actually private debt, not private equity. So we're issuing loans to borrowers of capital. Those borrowers are repaying those loans with principal and interest payments, and that interest payment is the profit.
Nice.
And the last asset class is developments. So we're actually doing real estate developments. We're constructing assets for the purposes of selling from within this fund structure. Now, the developments are actually the main driver of value in the fund. That's what really takes the profits to the next level.
Right.
Right? But it also is what increases the risk a little bit, right? Because developments are slightly riskier. But the nice thing about these types of funds, and this is different from conventional real estate investment, is you don't have to put in $250,000 in one. You can put the minimum of $5,000 in one, and then put $10,000 in the low risk residential fund. You can diversify your investments in a way that makes sense for you based on your risk profile, where you're at in your life, how many kids you have, how old are you? Are you a single father or a single mother, right? You can really tailor it so that it suits your needs. And part of my job is to figure out what those needs are and then to recommend a course of action.
I was just curious as to the payout that you're giving. Do you have to report that on your income tax as income?
Good question. So, you've unpacked a can of worms there. So I will answer your question. I realized I didn't touch on the returns for the balanced fund.
Go ahead.
So I said it was a riskier fund. I said it was a better performing fund. Let's quantify that. Residential fund, we target returns between 8 and 12%.
So average 10%.
It's also never dropped in value. With the balanced fund, we target returns between 12 and 16%. So it is a better performing fund, albeit a little more risky because of the developments that are contained inside. Both funds pay that 6% cash flow. So if cash flow's your game, you're going to get that 6% cash flow from either fund. Both funds pay 6%. They operate identically. They both pay on the 15th of every month. They've both never been missed. They've both never been lowered. Okay?
Awesome. And
now to answer your question.
Your CRA question, yes.
Taxation. So this is one of the main benefits of this type of investment, investing passively. Particularly with our residential fund, the first fund I mentioned. So let's walk through an example to really illustrate how these things are taxed. Let's say you go out and you buy yourself a duplex. You hear what I'm saying today and you're like, I want to go in alone. I want to do it myself. I want to be a landlord. And so you do it. You go and buy a condo, you put in a tenant, that tenant pays you 12 monthly rental payments. Now at the end of the year, all of that income is fully taxable. Now you can deduct certain expenses, mortgage interest, maintenance fees, whatever, but everything is fully taxable as income, and it's owed in the same year it's earned. With the residential fund, you're also going to get those 12 monthly rental payments, so to speak, but at the end of the year, not a penny of tax paid. Another year goes by, your distributions have gone up because the rent we charge goes up. We pass that through to our investors, of course. Also, not a penny of taxes owed. With the residential fund, the beauty of it is the taxable event does not occur in the year the income is earned. The taxable event occurs in the year the investment is sold. So I'll say that again. The taxable event does not occur in the year you earn the income. It occurs in the year you sell the investment. Right. So if you hold that investment for the 5-year minimum, as an example, you're not going to pay a penny of tax until year 5, the end of year 5, technically. At year 5, when you sell, you're going to have to pay all of the tax owed for all of the profits you've earned from year 0 through 5. However, this is the second benefit. Everything is taxed as capital gains, which is only a 50% tax burden.
Right.
Everything, including the cash flows. So no other real estate investment you're ever going to make is going to function like that.
Right. Interesting. Very, very interesting.
Yes. Is there an option at the end of the 5-year in order to avoid the taxes to just have those funds and gains just redistributed back into the fund so you go into another 5-year without paying any taxes?
So as long as you don't sell the investment, you won't trigger a taxable event.
Right.
So the minimum investment period is 5 years, but it functions like a stock, whereby you can stay invested for a week, you can stay invested for your entire life, for 30 years, right? It's always living, it's always growing and growing.
And the taxes are based on your income at that time, like what bracket?
Exactly, because you're deferring the tax, right? So you can wait, for instance, until you're in a lower tax bracket if you're approaching that part of your life. right? And this is all part of a broader strategy that I would identify with my clients. Now, one other advantage to this type of investing, and again, something you're not going to get with conventional real estate investment, is that these types of investments are eligible for TFSAs, RRSPs,
That's what I was going to talk about.
LIRAs, or ESPs, right? So you can tax shelter all of the profits that you're earning. And you can't go out and buy an investment condo with a LIRA or a TFSA.
So that's a key part. So part of why I wanted Lawrence to be here and just kind of like the difference between Chris and Lawrence. Chris, you're in a position where, you know, you have equity in your home and the whole nine, and you're able to buy another property. That's the conversations that I would definitely be looking into having. If you're in a situation where you have RRSPs, but you still want to invest in real estate, you can use your RRSPs this way. This is the only way you can use your RRSP. Unless you're a first-time buyer. If you're a first-time buyer, then the government will allow you to take out some RRSPs, which is, I think it's up to, what is it now, 30,000? So probably a little more. I think they increased it. But with your first-time buyer, you're allowed to do that. Outside of that, you shouldn't be touching your RSPs. You're going to get taxed for it. So this way, this allows you to still diversify in real estate by using the RSPs that you already have sitting there. I'm pretty sure you could use some of that and dump it into this, right? Go ahead.
Did you also say Lira?
Yep, Lira's in there, yes.
We can use
TFSAs.
any registered account under the sun except for the RDSP. The registered disability account we cannot use. Any other one you can.
You said RESP as well.
RESP, Lira, TFSA, RRSP. Yeah.
So that's where that's kind of, if you wanted to know how I envisioned this seminar going was, you know, Chris, go through the REAP. You'll figure out in terms of where you stand, if you're looking to buy your first home and all that. If you're not in that kind of position to buy your first home, if you're a first-time buyer, but you have some money that you want to be able to invest in and you're nowhere near necessarily getting your first home that way, obviously this is a way of doing it because, as we said, $220,000, unfortunately, is now a down payment.
It's really prohibitive.
Which is
crazy.
For
a lot of people.
Right, for a lot of people. I mean, obviously, there's other options. You're a first-time buyer, it could be a lot less, but it's just what it is, and that's where we're going. That's the direction we're going with terms of down payment. So these are just the different options. Do you have any other thing that you want to? I'm just trying to think of my mind. There's so many other questions that we asked in our webinar.
There's a lot we
By
can
the way,
talk about.
I have in my webinar. Yeah, I have in my webinar this conversation where we really dive in, and he goes way more into detail. Or you can always obviously contact him directly, which you're going to obviously be able to do.
That's how it starts. It's just a conversation at first. It's an education piece, right? A lot of investors don't even know these types of options exist.
100%.
Right? Or they think it's a one or the other type ploy. They think I can either buy that investment condo or a house or whatever, or do this. And it's not one or the other.
Do both.
They're complementary, right?
As you said, you have both.
Like I have 11 doors myself, but I love my Equiton investments because I put them where I put them. I can use my TFSAs.
Nice.
I don't have to worry about them.
Awesome.
Right? I know how they're going to perform year after year, month after month, and that serves me well. And in this environment where the stock market's going up and down like a yo-yo, my stock portfolio is down 20% this year. I can put it in something I know and understand, something that I trust, something that makes sense to me.
Awesome.
Right?
Started in 2015. What made you start the business?
Well, we've been in a bull run since 2015. So we've been the benefactors of some serious real estate appreciation. So that I won't ignore. But when you're buying properties, you have to buy them the right way, right? It's about more than just location, location, location. You need to do your due diligence. You need to do your market research. You need to pay attention to employment trends, immigration trends. There's lots that goes into prudently building a real estate portfolio, right? You don't just go and start buying houses on a block. When we started in 2015, we started with this idea that people were kind of shut out of the real estate market. And Chris touched on this. You want to get into real estate. It's something you know and understand. You don't know how, right? You don't know where to start. Or maybe you do. You just don't have $250,000. And so we created a product that was accessible to people, that could be explained to them and they could be educated on it in a very easy way. And it's a personal type of relationship, right? So I manage my clients personally. It's like a private banking relationship. I'm their advisor. If they have questions, they come to me. And it all started with this idea of, frankly, public service. Now, let me ask this question to the group at large. How many of you guys are familiar with a real estate investment trust, a REIT? Right? Show of hands. Okay, that's pretty good. So essentially what we operate is a private REIT. So we're a private real estate fund. And we're private because we're not traded on the stock exchange. And this is to answer your question. What we were finding is that there are other firms like ours that do what we do, but they're publicly traded. They're listed on the Toronto Stock Exchange, New York Stock Exchange, or whatever the case may be. Because of that, their values, their market values fluctuate with the market. Right? When Putin decides he wants to invade a new city in the Ukraine, the whole stock market tanks. So does your real estate investment. Now, what does Putin have to do with the apartment buildings that you're invested in the real estate market? Nothing. But because of market sentiment and the way these financial markets operate, you suffer as an investor. And ultimately, you're playing with things you don't understand. There's people out there with a lot more money than us and a lot more insider information that are manipulating these markets in ways that I have an MBA in finance and I don't understand. Right? So being private allows us to circumvent that market risk because we're not traded on a stock exchange. We're not subject to the emotional whims that drive that financial market. Right? And that is what makes our investments so stable and so consistent. That's why I can sit up here and proudly say our investments have never dropped in value.
You said that with the residential fund, the interest return is about 6 to 10%, did you say?
8 to 12 for the res and 12 to 16 for balanced.
Okay, so what happens to the other 2 to 4% after you're paid 6% in cash?
Oh, I see what you're saying. So the remainder of the returns that you're not going to realize in cash is baked into the appreciation of the unit price of the fund. So when you purchase ownership units in, as an example, the residential fund, let's say you purchase your units at $10 per unit, right? You buy for $10,000 at $10 a unit, you get 1,000 units. You bought them at $10 a unit. Well, in year 5, when you decide to sell your investment, we're going to effectively buy them back from you. But when we buy them back from you, we're not going to pay you $10 per unit because now they're worth $12.25, right? So that $2.25, that's your profit. Same as when you actually own a piece of real estate, right? You buy a condo, you rent it out, it's going to double in value, let's say, but you don't get that until you sell the condo, then you get back all of your capital. But meanwhile, you get it, that monthly cash flow while you wait. So it works the same way.
You're technically just paying for your investment, like paying. It's like paying your mortgage, but when it's like building your equity by paying into your mortgage.
It's like getting your tenants to pay your mortgage off for you.
My question is, so I know you said you take pride in the fact that there hasn't been a downturn, but we understand that there's pros and cons, ups and downs. That you probably have strategies in place that if it does happen, that things take a dip or take a dive.
Well, they already have taken a dive.
Right. And what's the strategy, or what's in place for investors to say, like, okay.
Good question. What you're asking is essentially, Equiton, what's your risk management protocol? How are you protecting your investors' capital, right? There's a number of ways we do that. And first of all, it starts with the philosophy, right? The fact that our investments have never dropped in value stems from this belief where we value downside protection as much as we value delivering returns, right? And that's why we're not out there trying to promise that you're going to double your money overnight. That's not what we set out to do, right? We want slow and steady, prudent investments, just like you would employ yourself. One of the ways we do that is, as a rule, every property in both of our funds gets put on a 10-year fixed mortgage. Every single one. We're happy to pay a few percentage points higher of interest upfront in exchange for predictability.
Right.
Because our acquisition team, when they're building their financial model, can use that predictability to predictively predict cash flows. Sorry about that.
Yeah.
Maybe cut that out in post.
No, we'll keep it.
But predictability is the name of the game, right? And so that's one of the ways that we manage risk. So in today's rising interest rate environment, the entire bulk of our portfolio is literally unchanged. Right? Now, subsequent acquisitions will be affected by higher rates. We'll have to lock in at a higher rate, but the portfolio as a whole is unaffected.
Makes sense.
And then we do what we can. And the other way we manage risk, to build on that point, is we have a very low loan to value across the portfolio. We have a portfolio-wide loan to value of 49.5%.
Wow.
So 50%, let's call it 50%. That is a stark difference of one of you guys going out and buying a home with 5, 10, 15, 20% down, right?
Just explain that.
So we're very well
just
capitalized. Oh, yeah, let's dial it back a bit. So a loan to value means of the portfolio of assets that you own, all the properties you own, what percentage does the bank own? What is the percentage of mortgages that you have on all of your properties together? Right? And ours is at 50%, which means on average in our 30 properties in the residential fund, we own 50% of all of them.
Which, as I said, like as he's saying, normally you see
first time buyer, it could be as low as you putting in 5% and the bank owns 95, right? And on average, it's usually, especially when you're getting started, 20%. So you put in 20% of your money, but the bank is putting 80%. He's saying that they're putting up to 50%.
We do 50, and we like to do, well, it's in and around 50, right? Some of our properties might be at
More or
30,
less.
some of our properties might be at 70, but the average is 50. When you're dealing with a portfolio this size, the average is more important than each individual.
Right.
You care about the portfolio as a whole.
Right.
And again, we do that because we want to be strong. We want to be very well capitalized. The more leverage you use, the more sensitive you are
100%.
to exogenous forces, like rising interest rates,
For sure.
right? Like defaults on rent payments as vacancy rates increase, right? The more capitalized we are, again, it's a protective mechanism.
The properties in your fund, they are all owned by your group company, whatever?
They are owned. It's a good question, and I always catch myself saying we as an Equiton own it, our investors own it. So we'll speak very literally. We go out and buy an apartment building. We, Equiton, does not buy it. The Equiton Residential Income Fund Trust purchases it. You own 20,000 ownership units in that trust. You are the indirect owner. Indirect because your name isn't on the title, but you own it.
The underside to my question is that basically it is an ownership structure. You're not necessarily investing in like you mentioned the REITs, whereas REITs they don't necessarily own the real estate.
Exactly. So Equiton Capital does not own the real estate. Like I said, our investors do, but Equiton presides over the funds. So we are employed by the funds to manage them prudently, right? So again, we have our own in-house team of property managers. We do our own acquisitions. Everything is done internally.
The fund is the owner.
The fund is the owner.
You're not, like, the fund is not investing in Cadillac Fairview or whatever.
No.
You are
the fund is the owner. The fund's name is on the title. I mean, a little more complicated than that. There's numbered companies involved and stuff to limit liability, but the gist of it is just that. And you as an investor, if you were to say, Lawrence, where does my money go? Literally, where does it go? You are in making an investment. We are issuing you ownership units in that very entity. That's how it works. And it's an equity ownership. You're not giving us a loan. We're not paying you an interest rate. You own these assets.
How often can you invest? Like, say you start off with your 5,000, and then you got 10,000 more that you want to invest.
Mm-hmm.
Can you invest on top of that 5, or do you invest in another?
No, it works just the way you had intimated. So think of the structure like a stock, right? You can buy Tesla stock. You can put in $1,000 today, and then in 6 months you get that big bonus at work. You can put in another 5,000, right? So it's cumulative, and this works identically. And it's the same when you're selling, right? If you accumulate a huge position, $100,000 worth, you can start paring that back in $10,000 increments, right? You don't have to sell all or none.
Couple more questions, and then we'll wrap it up. Go ahead, sir.
It might be a silly question, but how do you guys make money?
That's a great question.
That is a very important question.
I was going to ask that at the end. Don't worry, go ahead.
It's a good question. So we charge an MER, which is a management expense rate on the fund itself. And it's charged based on the amount of assets. Now, part of that is our profit, of course, but don't forget, we do all of our own in-house property management, right? So there's 125 employees at Equiton, most of which are property managers managing these 2,000 plus units. Now, all of the returns that we discussed today, the 8 to 12 for the residential, the 12 to 16 for the balanced, both of which include that 6% cash flow, this is the net return to our investors. So I don't speak any top line numbers, I just give brass tacks. This is the returns our investors receive.
Where do you invest in? Number one.
Like area? Like geographically?
Yeah, like your portfolio of investments in which city, which country, and are you doing any new developments now, or you just purchase buildings and put it in the portfolio?
Yeah.
Well, that's true.
Awesome questions. So I'll say that we are a 100% Canadian-owned and operated country. Both of our investments are purely in Canada. So we're Canadian investors, full stop. In the residential fund, all of our properties are located in Ontario, with the exception of one property, which was literally acquired today officially. It's our first property in Alberta, specifically in Edmonton. We really like Alberta, very attractive valuations out there. And so we wanted to fulfill our mandate of being a truly national firm. We have investors that live in Alberta and BC, and they're like, when are you guys coming out here? Right? There's a lot of good stuff. And so we're trying to push and increase our presence out there. Developments. So earlier in the talk, I was talking about the two styles of investments we have, our fund style and our direct investment in land developments. So these are different from the funds. You're actually investing in a certain development project. Like let's say we're building a condo and you're sharing in the construction of this product, this condo. These are kind of they're on the riskier side of investments, certainly relative to the low risk funds that we offer, but they're incredibly lucrative. So with our developments, we target returns upwards of 20% a year. So this is the type of investment where in 5 years, you will double your money. That's how it works. Currently, we're building a mid-rise condo in Toronto in the city's East End. It's a 4-minute drive from the Scarborough Bluffs. Really nice area down by the lake, pretty affluent area. 12-story condo, 300 units. We're raising $38 million of capital to do this. The targeted term to completion on this is 5 1/3 years, and the total ROI, 106.6%. And development investments in real estate are sort of the best kept secret. If you can do away with that money for a little while, you can stand to not see it for 5 years, you're going to make a lot of money in these investments.
Guys, I really do hope you found this valuable. Lawrence, Chris, I appreciate you guys so much. That was awesome. Wow. I learned a lot too. Clueless? As clueless.